World War I killed 20 million people, destroyed 4 empires, and redrew the map of the world. But the battles you read about in history books, the trenches, the gas attacks, the futile charges into machine gun fire, those were just the visible surface of a deeper conflict. Beneath every offensive, behind every strategic decision, there was another war being fought in bank vaults, government treasuries, and private meetings between financiers who wielded more power than most generals. Because modern wars aren't won by courage or tactics alone. They're won by money, by the ability to borrow today against tomorrow's production, by financial networks that can move capital across borders faster than armies can move across battlefields. World War I was the first truly industrial total war, and it required financial innovation on a scale humanity had never attempted. The Great War wasn't just financed by governments issuing bonds to patriotic citizens. It was financed by a hidden network of bankers who saw opportunity in catastrophe, who lent billions at interest while millions died, and who understood that the real prize wasn't territory or victory, but the post-war financial order they would design. Understanding who financed World War I means understanding who truly controlled the conflict, who profited from the carnage, and how the war's financial architecture shaped the world we still live in today. When Archduke Franz Ferdinand was assassinated in Sarajevo on June 28, 1914, the immediate question facing European governments wasn't whether to go to war. That decision was driven by alliance systems, national pride, and strategic calculations that had little to do with economics. The question was how to pay for war on a scale no one had seen before. Previous conflicts had been limited affairs, fought by professional armies over months or at most a few years, financed through existing government revenues and modest borrowing. But military technology had advanced dramatically. Machine guns, artillery, and railways meant wars would involve millions of soldiers, consume unprecedented quantities of ammunition and supplies, and potentially last for years. The costs would dwarf anything governments could pay from current revenues. They would have to borrow, and borrow massively, from anyone willing to lend. In Britain, the government initially believed the war would be short, perhaps over by Christmas 1914, a common sentiment that proved tragically wrong. In the first weeks, the Treasury financed war spending through ways and means advances from the Bank of England, essentially overdrafts where the government borrowed directly from the central bank. This worked for immediate needs but couldn't sustain prolonged conflict. By autumn 1914, with the Western Front solidifying into trench warfare and no end in sight, Chancellor of the Exchequer David Lloyd George presented the first war budget to Parliament on November 7th, showing a deficit of £339 million, on the assumption the war would last until March 1915. Even this estimate proved wildly optimistic. The war would last 4 more years and the true costs would be catastrophic. The solution was the First War Loan, announced in November 1914, a bond issue designed to raise $350 million from the British public. To understand how extraordinary this was, consider that the largest previous government bond had been $60 million to finance the Boer War in 1901. The First War Loan was 6 times larger, equivalent to roughly $35 billion in today's money. An astronomical sum in 1914 when Britain's entire GDP was perhaps $2.5 billion. The loan paid 3.5% interest and would be repayable between 1925 and 1928. The government expected patriotic fervor would drive subscriptions, that citizens would see lending to their country in wartime as both duty and sound investment. But the government was nervous, terrified actually, that the loan would fail to be fully subscribed. Such a failure would signal to enemies and allies alike that Britain lacked confidence in its war effort, that its financial system was weaker than assumed, and that Germany might prevail simply by outlasting British credit. So Lloyd George met secretly with representatives of Britain's major banks on November 16, 1914, at the London County and Westminster Bank. What transpired in that meeting reveals the hidden financial architecture of the war. Lloyd George didn't just request that banks purchase bonds, he demanded they underwrite the entire issue, meaning if the public didn't subscribe fully, the banks would be legally obligated to purchase whatever remained. The bankers understood what was being demanded. They were being conscripted for financial war, required to risk their capital not because it was profitable, but because the government needed them to ensure the loan wouldn't fail publicly. The banks agreed, nearly all of them subscribing 5% of their deposits to the loan and underwriting an equal amount. This commitment alone brought in over $60 million. The Bank of England committed to purchase another $40 million directly. That left $250 million to be raised from the general public and other sources. When the subscription period closed, the results were disastrous. Only $91 million had been subscribed by the public, less than one-third of what was needed. The burden of taking up the remaining £159 million fell on the underwriting banks, who managed to absorb another $46 million from their own resources. But that still left $114 million of unsold bonds, nearly one-third of the entire issue. What happened next was hidden from the public for decades and reveals the true nature of war finance. Two Bank of England officials personally took up the remaining $114 million in stock, funded by secret loans from the Bank of England itself. Let that sink in. The government's war loan, presented to the public as a test of national resolve and financial strength, had failed so completely that one-third of it had to be secretly purchased by the central bank lending money to its own officials to create the appearance of success. The Bank of England's ledgers, examined by researchers decades later, revealed the extraordinary role the institution played in covering and then concealing the shortfall. The public was told the loan had been a success, that Britain's financial might was unquestioned. The reality was that the government had barely avoided catastrophic failure only through accounting tricks and secret central bank financing. This pattern, government borrowing backed by central bank money creation and hidden financial manipulation, would define how World War I was financed by all belligerents. But in 1914, the British government still hoped to tap genuine public savings rather than rely entirely on banking system credit creation. They needed a different approach, something that would reach ordinary citizens and make it logistically possible for millions to lend small amounts. The answer was the Second War Loan, issued in June 1915. This loan offered 4.5% interest, higher than the First War Loan to compensate for wartime inflation and reflect the growing desperation for funds. But the key innovation was marketing. The government launched an aggressive propaganda campaign urging citizens to lend to their country, to contribute to victory, to prove their patriotism through financial sacrifice. The Second War Loan was a stunning success, at least on the surface. The Bank of England received an incredible 547,000 applications, totaling over $571 million in new money, 10 times more applications than the First War Loan, with an average subscription of about £1,000 per applicant. Including conversions from the First War Loan and other government securities, the total issue reached over $900 million, equivalent to $90 billion today. The government and press celebrated this as proof of national unity and financial strength. But beneath the triumph was a darker reality. Much of the money subscribed came from banks extending credit to their customers specifically to purchase war bonds. The Bank of England had offered to make loans to commercial banks against war loan stock at rates 1% below the bank rate, creating an incentive structure where banks would lend to customers who would buy bonds pledged back to the banks as collateral for the loans that financed their purchase. This circular financing, where the banking system created credit to purchase government bonds, which were then used as collateral for more bank lending, wasn't fraud exactly. But it meant the government wasn't primarily tapping existing savings. It was tapping the banking system's ability to create money through lending, expanding the money supply to finance the war. The consequence would be inflation, the dilution of everyone's existing money through creation of new money to fund government spending. Prices in Britain roughly doubled during the war, meaning workers' wages bought half what they had before. This was a hidden tax, one that ordinary people paid through reduced purchasing power while bondholders collected their guaranteed interest payments. Throughout 1916, the British government continued borrowing through shorter-term exchequer bonds, raising over £500 million through various issues. These bonds, offering 5% and later 6% interest, were sold repeatedly as previous issues matured, constantly rolling over the debt. By early 1917, Britain had borrowed over $2 billion for the war, more than an entire year's pre-war GDP. The interest on this debt was becoming unsustainable, consuming a large portion of tax revenues. The government needed one final massive loan, something that would consolidate existing debt and provide funds to continue the war through what everyone hoped would be its final year. The Third War Loan, issued in January 1917, raised an astonishing $960 million in new money from just over 2 million subscribers, more than the first two war loans combined. Including conversions of previous loans and bonds, the total issue reached $2.128 billion, about $161 billion in today's terms. This was a vast sum, representing nearly an entire year of Britain's pre-war economic output, now owed to bondholders who would collect interest for decades. The success of this loan, unlike the First War Loan's hidden failure, was genuine. But it came at a price few understood at the time. The The government had mortgaged Britain's future to finance the present war. The debt would have to be serviced through taxation for generations, transferring wealth from ordinary taxpayers to bondholders, many of whom were banks and wealthy individuals who'd profited from the war they'd financed. But Britain's financing challenge, as enormous as it was, paled compared to the demands of financing not just its own war effort, but those of its allies. Russia, France, Italy, Belgium, and other Entente powers needed money, weapons, and supplies they couldn't produce or purchase on their own. Britain became the financial hub of the Allied war effort, extending credits to allies totaling £1.825 billion during the war. France lent £2.2 billion, nearly half to Russia, and the remainder to Belgium and smaller allies. These loans created financial obligations that would poison international relations for decades after the war ended. Allies that had fought together and bled together would spend the 1920s and 30s arguing over debt repayment, with debtor nations claiming the loans had been joint investments in common victory, while creditor nations demanded repayment with interest. But the true financial power behind the Entente wasn't Britain or France. It was the United States, which before entering the war in 1917 had become the Allied powers' banker, arsenal, and economic lifeline. American financial institutions, particularly J.P. Morgan and Company, organized loans to Britain and France totaling billions of dollars. These weren't government-to-government loans initially. They were private loans from American banks and investors to Allied governments, with J.P. Morgan acting as the lead banker and purchasing agent. Morgan's firm didn't just arrange financing. It purchased American war materials, agricultural products, and other supplies on behalf of the Allies, taking fees on every transaction. The war was extraordinarily profitable for Morgan and other American banks involved in Allied financing. They collected interest on loans, fees on transactions, and grew wealthy while Europe destroyed itself. But these private loans carried risk. If Germany won, Britain and France might default, destroying American investors who'd lent billions. American financial interests became committed to Allied victory not from idealistic motives, but from cold calculation that defeat would mean financial catastrophe. When the United States finally entered the war in April 1917, the financial relationship shifted. Private loans were increasingly replaced by government-to-government credits as the U.S. Treasury took over Allied financing. By war's end, the United States had provided over $10 billion in government credits to allies, with Britain receiving a large portion of that total. These government loans were financed through American bond sales, Liberty loans marketed to American citizens through massive propaganda campaigns urging patriotic investment. The Federal Reserve, established just 4 years before the war began, facilitated this borrowing by purchasing Treasury securities and providing preferential loans to banks buying government bonds. The Federal Reserve's role in financing America's war effort marked its first major test and revealed its true purpose. The Fed wasn't primarily about stabilizing currency or managing inflation, though those were stated goals. It was about enabling government borrowing on an unprecedented scale, creating a mechanism where private banks could extend credit to the government, while the Federal Reserve provided liquidity to ensure banks wouldn't fail from overextension. The system worked brilliantly from the government's perspective. America borrowed over $30 billion during its relatively brief participation in the war, all without raising taxes sufficiently to cover costs. The bill would be paid through post-war inflation and decades of debt service, transferring wealth from taxpayers to bondholders, but the immediate needs were met. On the other side of the conflict, Germany and its allies faced even more desperate financing challenges. Germany couldn't access international capital markets as Britain could. Its alliances were with weaker powers, Austria-Hungary and Ottoman Empire, who needed German financial support rather than being able to provide it. And the British naval blockade made it difficult for Germany to trade for supplies it couldn't produce domestically. Germany financed the war primarily through domestic borrowing, issuing war bonds to its own citizens and banking system. But as the war dragged on and victory seemed increasingly unlikely, Germans became less willing to lend. The government resorted increasingly to printing money directly, creating currency without borrowing, which fueled inflation that would explode into hyperinflation after the war ended. The hidden bankers who financed World War I weren't motivated by patriotism or ideology, though they certainly wrapped themselves in national flags when convenient. They were motivated by profit and the opportunity that total war presented to remake international finance in their favor. The war destroyed the pre-1914 international gold standard, the system that had facilitated global trade and capital flows. With gold convertibility suspended by all major powers to finance war spending, currencies floated against each other, creating instability and uncertainty. The bankers who'd financed the war understood that the post-war world would need a new financial architecture, and they intended to design it. Even before the war ended, British and American financial officials were planning the post-war monetary system. The challenge was that Britain, despite being on the winning side, emerged from the war effectively bankrupt. Its gold reserves were depleted, its debts were astronomical, and its economy had been distorted by 4 years of total war mobilization. The United States, by contrast, emerged richer and more powerful than when it entered. American banks held European debt. American industries had expanded to supply Allied war needs, and American gold reserves had grown as European gold flowed to pay for imports. The balance of financial power had shifted irreversibly across the Atlantic. The Paris Peace Conference in 1919 focused publicly on territorial settlements, drawing new borders and assigning blame for the war. But the economic and financial negotiations were equally consequential and far more complex. The Treaty of Versailles imposed reparations on Germany totaling 132 billion gold marks, equivalent to roughly $442 billion in today's money, though this figure would be reduced in subsequent negotiations. But Germany's actual ability to pay was severely limited. Its economy was shattered, its gold reserves were gone, its industrial capacity was depleted. The only way Germany could pay reparations was through massive exports creating trade surpluses, but that required Allied nations to accept German goods, which would compete with their own industries and workers. The economic logic was contradictory, but political pressure from populaces demanding Germany pay for the war's costs trumped economic rationality. The reparations scheme created a circular financial flow that enriched bankers while impoverishing populations. Germany would borrow from American and British banks to make reparations payments to Britain and France. Britain and France would use reparations receipts to pay debts to the United States. The United States would lend more to Germany to continue payments. At each stage, bankers collected fees and interest. The real economic transfer was minimal, but the financial sector extracted profit from circulating paper while genuine economic recovery was delayed by the burden of servicing these interconnected debts. When the system finally collapsed in the early 1930s, triggering the Great Depression, it was the bankers' own scheme that destroyed the fragile economic recovery they'd supposedly been managing. The hidden bankers who financed World War I achieved their ultimate objective in establishing the post-war financial order. The gold standard wasn't restored in its pre-war form. Instead, a gold exchange standard emerged where the US dollar and British pound served as reserve currencies, supposedly backed by gold, but in practice managed by central banks with far more flexibility than the rigid pre-war system allowed. This gave American and British financial institutions enormous advantages. International trade would be denominated in dollars and pounds. Central banks worldwide would hold these currencies as reserves, and the Federal Reserve and Bank of England would effectively control global liquidity by managing their respective currencies. The bankers had transformed wartime financing into permanent financial hegemony. But the true cost of how World War I was financed wasn't measured in interest payments or gold reserves. It was measured in the political instability and human suffering that followed. Germany's reparations burden and the hyperinflation caused by printing money to meet those obligations destroyed the German middle class and created conditions for Hitler's rise. Britain's enormous war debts, held substantially by American creditors, forced austerity and deflation that caused mass unemployment and industrial decline. France faced similar challenges, ultimately defaulting on debts to the United States. And the interconnected web of debts between former allies poisoned diplomatic relations, making international cooperation difficult when it was most needed during the Depression. The League of Nations, created to prevent future wars, was fatally weakened by these financial disputes. How could nations cooperate diplomatically when they were fighting economically over debt repayment? The answer is they couldn't. The 1920s saw brief recovery interrupted by financial crises. The 1930s brought full collapse as the debt structure created during the war proved unsustainable. And the political extremism that emerged in the Depression's wake led directly to World War II, a conflict that in many ways was the unfinished business of the First War, driven by economic grievances as much as territorial or ideological ambitions. Looking back, the financing of World War I reveals patterns that have repeated in every major conflict since. Wars are too expensive to pay for through current revenues, so governments borrow. Central banks facilitate this borrowing by creating money and purchasing government bonds. Private banks profit from the process, collecting interest on loans and fees on transactions. Propaganda convinces citizens that lending to government is patriotic duty. and the costs are hidden through inflation and deferred through long-term debt service that burdens future generations. The visible war is fought by soldiers on battlefields. The hidden war is fought by bankers in boardrooms, and it's often the hidden war that determines not just who wins, but what the victory means. The bankers who financed World War I understood something that most people didn't and most people still don't today. Money isn't neutral. It's not just a tool for facilitating transactions or measuring value. Money is power, the ability to command resources, direct production, and shape societies. And control over money creation, over who gets credit and on what terms, is the ultimate source of power in industrial economies. Wars, as expensive as they are in lives and destruction, are opportunities for those who control finance. They allow rapid accumulation of wealth through interest on enormous loans. They allow restructuring of economic systems in ways that peacetime politics wouldn't permit. And they create dependencies, where nations that fought together become bound by financial obligations that persist long after the shooting stops. The hidden bankers who financed World War I weren't villains in any simple sense. They believed, or at least claimed to believe, that they were serving their nations, enabling victory, and ensuring economic stability. But their service came at a price measured in interest payments, monetary expansion, and post-war debt burdens that caused human suffering far beyond the trenches. The Bank of England's secret purchases to cover the First War loan's failure, the circular financing of the Second War loan through bank credit, the exploitation of Allied desperation by American banks, the imposition of reparations structured to benefit creditors rather than promote recovery. All of these reveal a system where profit motive and power accumulation shaped financing decisions as much as or more than genuine economic or strategic concerns. Today, when governments borrow trillions to finance military operations, economic stimulus, or pandemic response, the mechanisms are essentially unchanged from 1914. Central banks purchase government bonds, creating money to do so. Private banks facilitate the process and collect fees. The costs are hidden through inflation and deferred through long-term debt. And the public is told this is necessary, inevitable, the only way to meet national needs. But the example of World War I shows the costs of this system, not just the financial costs paid in interest and inflation, but the human costs paid in political instability, economic collapse, and ultimately another world war that might have been prevented if the First War's financing hadn't created conditions that made the Second inevitable. The bankers who financed World War I operated in shadows, meeting privately with government officials, making decisions that affected millions of lives, and profiting from catastrophe. Their names, institutions like J.P. Morgan and Company, Bank of England, and the newly created Federal Reserve are known. But their role, the hidden financial war they fought and won while soldiers died in trenches, is rarely examined with the scrutiny it deserves. Understanding that role means understanding that wars aren't won or lost just on battlefields. They're won or lost in financial systems, in the ability to borrow and create money, in the willingness of bankers to finance one side or another. And that understanding reveals uncomfortable truths about power, about who really controls nations and economies, and about whose interests are served when countries go to war. If this gave you a new perspective, hit subscribe. History doesn't repeat, but the hidden bankers never stopped financing wars. And the next conflict, like everyone before, will be fought with weapons you can see and money you can't, while the bankers who provide that money collect interest on humanity's suffering.